Hello, and welcome to the Stockout for July 18th. The Stockout is your show at FreightWaves about the consumer packaged goods industry, the CPG industry. So we talk about that very important industry of shippers and their supply chains, and also what we're seeing in FreightWaves data, which is a high frequency series of data sets, gets updated every day. So I'll talk through some of those things, a little bit more specifically. Today, I'll talk about what I expect from CPG companies' earnings as they start to report their second quarter. I've had a couple companies report already, but most of them will report in their second quarter in July and August. So I'll talk through some of those trends and what those companies are interested in, and what I think investors are going to be looking for in those things. Also, just talk through some high level trends for CPG as far as how they're managing their supply chains. Sort of not surprisingly, supply chains in general have been elevated to being CPG executives' number one concern, and I'll give some additional detail there. And then I'll go through some of the highlights in FreightWaves Sonar, which is our data product, provides high frequency data. I'll go through a little bit of ocean, rail, and trucking, sort of the three major sectors that we cover in FreightWaves. But first, talk here about CPG earnings. The second quarter earnings season is upon us, and I really think the main question is going to be around consumer elasticities. So far, CPG companies, sort of across the board, have talked about consumers' behavior not changing as much as they would have expected, given the high rates of inflation. So they've talked about elasticities either being non-existent or being below historical trends or below their own expectations. So some of the CPG companies that have raised prices, let's say 4 or 5%, have seen no changes in consumer behavior. Those have raised the prices 8-9%, have maybe seen 1 or 2% degradation in sales volume. And some of the CPGs that increased their prices 7 or 8% sort of in the last 12 months, going forward, talking more like a 15% price increase, trying to ram those through maybe before retailers are no longer receptive to those. They're expecting a decline in volume somewhere more like 5 or 6%, which would still be pretty beneficial to CPG companies' bottom lines if elasticities stay that low. So that's sort of the big question, I think, for CPGs is are consumers really going to change their behavior in response to the rising prices, or are they going to choose to cut back on other things that are not CPG? I tend to think that it's easier to cut back on big ticket items like electronics, furniture, and just delay those purchases, but still buy the same consumer goods that you tend to buy every week. Another question is really the CPG input costs past their peak. Rising input costs for CPGs have been a big issue really for about the last year and a half. Really some of the stock analysts started picking up on this as soon as the commodities started to increase sort of early 2021, particularly those things for agriculture, transportation costs, some of those costs. And, commodity costs are off their high. I have a chart from, bar charts in there, and you can see this is the S&P GCI commodity index. And so this includes a lot of the commodities that CPG companies use. It also includes things like lumber and copper, but you can see that it peaked, on the right. That peak on the right was in late June, and since the commodity index has retreated about 20%, and it's a big deal for CPGs that have really struggled with rising input costs and passing those costs along. So with those higher input costs have been margin contraction that we've seen in CPG industry. Most of the companies in the past year have seen their margins contract at least a few hundred basis points. Just saw the latest economic data that came out showing the CPI up 9.1% year over year. So those are the prices that consumers pay, and you compare that with the PPI. Those are the prices that the companies pay. Those are up 11.3%. And so it's not unique to the CPG industry that you're seeing margins squeezed with companies not sort of fully passing on their costs to consumers, at least not yet. Some of those price increases are still to come. But that's something that I think people are watching is when are CPG companies going to be able to fully pass on their price increases to consumers. Related to that is the retail relationships that the CPG companies are involved with. And a lot of the sentiment lately has been that CPG companies have been passing on steep price increases, through the retail channels quickly, because the retailers have taken a more active approach in basically auditing what CPG companies are doing in terms of their price increases, and the retailers in some cases are modeling whether those price increases are really justified by the input costs that the CPG companies incur, whether those are ingredients, packaging, transportation, all of those things, and seeing if that double-digit price increase is really justified. So I'd say the relationship with the retailer is going to be a little bit more contentious, and so that'll be a topic of discussion when the companies report their earnings. Also, the product shortages, I think, is going to be another area of discussion here. I mean, sort of in the last year, one example that comes to mind is on cereal. General Mills taking share from Kellogg. Kellogg had all those issues with the strike, with not having the right products in place. They also had a fire that was disruptive. They had to import more cereal that was manufactured elsewhere, and General Mills took share, even though that they've been very public about their own supply chain issues with trucks not showing up on time, not knowing when the trucks are going to arrive, all of those things. And so General Mills has gone into a little bit more of a just in case inventory situation instead of just in time. So those are kind of the big metrics to watch for when CPGs start to report. So far, I think they've done a solid job on the demand side. Really haven't seen a lot of degradation there, but they are looking to regain some of the margins that they lost in the last year, some of the basis points on their gross margin. Topic number 2 is supply chain disruption is the top CPG concern. And so this comes from an article that in Food Dive, which is a newsletter that I subscribe to. They do a lot of good work on food products, particularly within consumer packaged goods. And I'll read some of the stats here. This is from a survey in June conducted by Trace Grains. It said 58% of CPG executives say their biggest challenge has been supply chains. These are executives in the food, beverage, and dietary supplement industries. More than 60% of CPG executives say they've changed at least 6 of their product recipes in the last 2 years, and 37% say they modified 20% or more. 49% they have said they've halted production of certain items. So that goes to big trend in CPG, reducing the number of SKUs, making things at least a little bit simpler. Figure need 20 different types of diet soda. 70% of CPG executives said they plan to increase their supplier diversity in the next 2 years. I think that's important when there's supply chain issues. And so basically changing recipes, diversifying suppliers, reducing SKUs, trying to do things to either provide more sort of bumper stock to as sort of safety stock, or making the supply chain simpler. And I would add, one thing that wasn't mentioned was just really sort of increasing the inventory levels, where it doesn't make a lot of sense to have sort of this just-in-time inventory when not having one ingredient can sort of shut down the whole whole operation. So I think CPGs are going to run with a little bit more working capital in there. And another thing that's caused CPGs to have more supply chain complexity here lately has been the greater use of contract manufacturing. During the pandemic, there was a boom for CPG items. A lot of cases, CPG companies didn't have the manufacturing capacity in-house. They've had to rely on external manufacturers. That capacity has been very expensive, and it also leads to more supply chain issues. You have more finished goods in more places. You have to move more ingredients to more places. And that could be maybe a silver lining if there is some elasticities with demand here with CPGs. Is the first manufacturer they're going to get rid of is that expensive contract manufacturing, bring more of it in house, and that could actually help their margins somewhat. Moving on to topic 3, ocean spot rates continue to decline. I have a chart on this, a sonar chart that shows the Freightos Baltic daily index. And so I'll explain this for those that are watching the video version. Is in orange is the Freightos Baltic daily index from China to the U.S. East Coast. So those are ships that go through Panama Canal. These are spot rates, so what the rate is for that particular day. In green, same thing, except it's from China to the West Coast. And so those rates, for the most part, always going to be less than China to the East Coast, because it's just a much shorter trip. If you want to think of it taking another 2 weeks to go from China to the East Coast versus China to the West Coast. In blue, you have the spread. So just the difference between the cost to move a container from China to the East Coast minus container from China to the West Coast. And so that's important because it tells you a lot about what's happening in the industry. So the ocean's spot rates from China to the U.S. to the East Coast down 43%, from China to the West Coast down 53%. The spreads increased 16%. So usually, when you think of goods that are headed to the Eastern U.S. consumption centers, the cheaper option is moving it all water through the Panama Canal to the East Coast, because you have less surface transportation costs. So what more you pay in ocean is more than made up for with less surface transportation costs. During the height of the pandemic, early 2020, you saw that spread decline, and that's because there was a greater preference from shippers to move goods through the West Coast in order to get those goods to market quickly. And we're seeing a reversal of that with higher inventory levels, at a lot of the retailers. And so you've seen that spread, that line in blue there, increase about 16% from where it was, a couple of months ago. So it tells you that there's more capacity on the water, sort of number one. And number two, the shippers are less concerned with getting those goods to market quickly. So if you're an importer, a shipper, this is good. This is good news. Another chart we have is this ocean TEU booking lead times, which is orange chart. This is from a brand new data product that we've just incorporated into Sonar that Henry Byers was the architect, ocean expert. And this shows the ocean TEU booking lead time. So you see this down, and it declined from about 14 days, at one point 16 days. Now it's down to about 9 days. And so when shippers are concerned with securing capacity on the ocean, just like tender volume in the trucking industry, they'll push those lead times longer. If they're less concerned with finding space on the vessel, these lead times decline. This shows you that shippers are less concerned with finding space on the vessel. Lots of other examples of that. In Sonar, another one that stands out is the transit times, which have actually increased quite a bit. And the reason for that is that there's excess capacity. The vessel carriers can save quite a bit of fuel by what they call slow steaming, which is reducing the speed of the vessels, and you've seen those transit times increase as a result. Which all of those things tells you there's more capacity on the water. And I think it leads nicely into a discussion on rail service, which have a chart here on the international rail container volume. And so what has happened with the excess, with at least the increase in the amount of excess capacity on the water, is there's also been more availability of international shipping containers. So those are the 40-foot containers that travel across ocean, that sometimes go intact, intermodal. Sometimes they stay at the ports and go right back on the container ship. But see in 2021 is green, and you saw sort of throughout last year a decline in that volume, and that was because there was a shortage of those international containers. The container ship lines did not want to send those inland from, let's say, Chicago, from Los Angeles to Chicago or Los Angeles to Dallas. They wanted to keep those close to the harbor to preserve that capacity. What's happened lately with the excess ocean capacity, they've been much more willing to send those containers inland. And so it looks like that blue line, which is 2022, about to cross 2021, it's going to be up year over year, I would imagine, for the rest of the year, which is, on surface, good news for shippers, although it is leading to more congestion at inland points because more containers are being sent inland into places like Chicago. There's been more congestion, on and around intermodal terminals, not enough places to put the boxes, not enough chassis, all of those things. Which gets into the next topic, which is rail congestion is rampant at the West Coast ports, and really been a lot talked about this. The number of containers that are just sitting at the ports of LA Long Beach. There's been a big uptick in the overall volume, and about 60% of those can be attributed to the rail because those are containers that are supposed to move on the railroad. And a lot of those are dwelling for longer than 9 days. The ports of LA Long Beach publish the number that are dwelling for longer than 9 days, and that part has really risen as well. And when the rails discuss this, they attribute a lot of this to not having the personnel, and have a chart here on the total carloads versus rail. And so usually what happens is the railroads, they're able to scale up and scale down their employment force, for volume. So volumes fall, they either lay off workers or they furlough workers, which means if workers get to keep their benefits and can be called back when volumes recover. And usually the railroads, when they do that, when they scale back their employment base, they're able to ramp that right back up as soon as volumes recover. And that didn't happen this time. And some theories as to why that didn't happen this time. I mean, I think there was some good commentary from Rachel Premack, journalist of FreightWaves, put out an article last week where she had some really good quotes related to employee morale at the railroads really, being depressed. Also the fact that the labor market is tight for skilled industrial labor, I think is playing a part of that. I think the workers' lifestyle is playing a big part of that. Not only are the hours long, but they're uncertain hours. There's more hours away from home. There's more times where even if they have enough people, the railroads do, they're not in the right places. And so that's led to less time at home. So all these things have contributed to the rail employees having a decline in morale. Maybe even the biggest one is the thought that the railroad employees have had to do more with fewer people because of the precision scheduled railroading, which is really a lot of cost cutting. And all of those things I think have put a lot of strain on workers. So a lot of workers that have left have sort of been happy to leave. I mean, that one stat that the average attrition in the railroad industry has gone from 7% to 10%. That's a big deal. Those are sort of voluntary, separations, and the rails haven't been able to hire back the employees that they terminated. Usually they are because they will make more on the railroad. Maybe they still would make more on the railroad. They just don't want to put up with that lifestyle. And really that sort of plays into topic number 5 here is the rail labor update. And with the rail labor, having a shortage of rail workers, I think plays into the union's hands because the market is telling you that either the wages are not high enough or the working conditions are too poor, or I guess the third option is, well, the market for skilled industrial labor is just so tight that they have better alternatives. But at least one of those 3 things has to be true. Maybe the workforce is just old enough. We've overeducated the workforce to the point where you're not going to get enough skilled laborers on industrial type jobs like railroad jobs. There's not enough people coming out of the military, which those are some of the better rail workers because they're used to doing much more difficult things than working on the railway. But all those things, I think, sort of play into labor's hands. And sort of the latest on the labor, as we are here on July 18th, was on Friday, Biden administration created Presidential Emergency Board. As expected, this is going to start the second of 3 30-day cooling off periods. So there is the potential for a strike in 60 days from now. So it's kind of September. And I think it's possible that will happen, but I don't think it's likely that that will happen for very, very long. I think with the number of hours, if that were to happen, Congress would order the workers back to work, using some of the recommendations from Biden's Presidential Emergency Board, which consists of 3 members. I have not dug into yet, their background, but I imagine that they are more sympathetic to labor than big business, just based on the fact that they're being appointed by this administration. So I would expect that unions will get a win here with some combination of certainly higher wages, but keeping most of their benefits, keeping most of the work rules that they want to preserve. So that's really sort of the labor update. Their status quo for now. Possible strike in 60 days. Topic number 6 is short haul volume seems to be outperforming longer haul volume on the highway, and so this chart is the city outbound tender volume index in the blue sort of shaded in portion. And one of the things in Sonar that's helpful is we can cut down and break down truck volume not only by equipment type, dry van, reefer, flatbed. We can do it by length of haul as well. And it's been interesting that the city outbound tender volume index has really outperformed these others. So city, we define that as 100 miles or less. Short haul between 100 and 250. And so that city and short haul, there's been more volume there in terms of tenders, so more demand for trucks movements in those shorter hauls than there have been for medium and longer hauls. And that's interesting. This was something that Zach Strickland from FreightWaves brought to my attention, and it shows that shippers are reorganizing their inventories, with surpluses and surpluses of some types of goods, shortages of others, goods in the wrong places. So a lot of things need to be moved sort of shorter haul, maybe within a metro area, to get them where they need to be. And also already seen some disruption with AB5. If you haven't been following AB5, there's a treasure trove of information about it on freightwaves.com. We followed it extremely closely. Have really owned the issue, I've thought. But AB5 makes it so independent contractors have to be considered company drivers. A lot of the trucking owner-operators are upset about this. They don't want to pay the insurance. They want to be their own business and have more autonomy, but a lot of it comes down to extra costs to have their own registrations and insurance and those things. But with AB5, just since mid-June to mid-July, we've seen the tender rejection rate go from 2% to 5% for city movements specifically. So typically moving a shorter length of haul, carriers are much more accepting of that type of freight than moving at longer haul. A city haul, usually you do have those very low single digit tender rejection rate. So it's been interesting that has changed as quickly as it has, even though it remains to be seen sort of how strictly this is going to be enforced, when it's going to be enforced, how exactly it's going to be enforced. Something that FreightWaves is watching really closely, reporting on. It seems like we have lots of information every single day about that. And I think that's the type of topic where FreightWaves really adds a lot of value, actually. Whereas other, news outlets, it's a little bit more of a surface level, an analysis. Whereas, we have lots of journalists that are, dedicated to that space specifically. And so that's why you want to check FreightWaves every day to see, what's happening with those type of issues. So that's really what I wanted to go over today, and invite you to sign up for my newsletter, which comes out once or twice a week every week. You can find that at www.freightwaves.com/the Stockout. You can also just go to freightwaves.com, go up to the top for newsletters, and there's a newsletter or a number of them that will appeal to you. We have newsletter on CPG, retail. I think there's overlap that CPG companies will be interested there, and also running on ice on the reefer side of things. That's one that I think CPG companies will be interested in too. Imagine there'll be some reporting on Martin Transportation, which reports its second quarter in the next day or two, but lots of good information there. For the rest of the week, I'm going to be following very closely the JB Hunt's earnings, which come out tomorrow, and later in the week. The rails are up my alley. CSX, Union Pacific, GATX, the big leasing company. Those companies that I used to follow on the trucking side. Knight Swift reports in the next couple of days. So there's going to be lots of information coming out. And if anyone needs anything from me, feel free to reach out at mbowdendistel@freightwaves.com.